Welcome to Talk Tickers, where we break down the earnings calls that really move the markets. Okay, so have you ever seen this? A company reports kind of met results, misses on sales, but then the stock just explodes. That's exactly what just happened with Oxford Industries. We got to break this one down.
Yep, you're seeing that right. A nearly 28% jump in a single day. This was for Oxford Industries, ticker OXM, and it all happened right after their second quarter earnings report dropped.
Now, here's the puzzle. On the surface, the numbers were, well, a classic mixed bag. So what gives? Why did Wall Street suddenly fall in love with these results? Let's dive in and figure this thing out.
All right, so the headline here is a classic beat and a miss. Kind of confusing, right? Let me show you what I mean.
So on one hand, Oxford absolutely crushed it on profit. We're talking adjusted earnings per share. But on the other hand, they came up just a little short on revenue. It's the kind of thing that makes you scratch your head as an investor.
Let's put some numbers to that. You can see their adjusted EPS landed at $1.26, which was a nice beat. But that revenue number, $403 million, just a hair shy of what everyone was looking for, and actually down 4% from last year. So again, what's the real story here?
Okay, so if it wasn't the headline numbers, what was the crucial piece that investors latched onto? Well, it turns out it was all about how they dodged a massive bullet. And that bullet? Tariffs.
Get this, management was looking at a potential hit of up to $80 million from tariffs for the whole year. I mean, that is a huge number that could have just wrecked their profitability.
But here's where things get good. This is where management really earned their paycheck. They didn't just sit back and take it. Nope. They came out with this crystal clear three-step plan to fight back. They started shifting their sourcing. They pulled inventory in early to beat the hikes, and they got smart with selective price increases. A total power move.
And the result of all that hard work? They basically cut that massive $80 million problem in half. They brought the final hit to their earnings down to a much more manageable $25 to $35 million. That is some seriously impressive footwork.
You know, CEO Tom Chubb said it best himself. We said last quarter that we would continue to control what we can, and we have. And that quote right there, that's what gave the market so much confidence. It shows they were in control, not just reacting to bad news.
And the cherry on top, the ultimate sign of confidence, they reaffirmed their full-year guidance for both sales and earnings. That's management basically looking the market in the eye and saying, yeah, we see the storm clouds, but don't worry, we've got this under control.
Okay, so that's the big picture tariff story. But let's zoom in a bit and look at the brands themselves. Because inside this company, you've got a portfolio in motion. And it's a real tale of two cities. Or, well, four brands. Just look at this chart. It really tells the story perfectly. On one end of the spectrum, you have the emerging brands group just crushing it with 17% growth. But then you look at the big guys, Tommy Bahama and Johnny Was, and they were actually in the red.
So let's break that down. Lilly Pulitzer? It's a bright spot. Consumers still love it. And those emerging brands? They're clearly the growth engine right now. But all that good news is getting weighed down by the struggles at Johnny Was, and, maybe more importantly, the flagship Tommy Bahama brand just wasn't pulling its weight.
But wait, there was another little nugget of good news that the market absolutely loved. Management mentioned that so far in the current quarter, sales were actually turning positive again. And guess who is leading that charge? Tommy Bahama. That's a huge sign that the turnaround plan there might actually be starting to take hold. All right, so that's the story so far. Now for the big question. Where does the stock go from here? Let's get to our rating. For us, there are really four key things we're going to be watching like a hawk. Number one, the holiday season for Tommy Bahama. Is this rebound for real? Number two, Q3 results. Can they actually hit the numbers they guided to? 3, the tariff situation. Can they keep up their amazing defense? And finally, are those new stores they're opening actually paying off?
So when we put it all in the blender, it's a mixed picture. The tariff resilience? That's a massive positive for sure. But you have to weigh that against the mixed momentum across the brands and, let's be honest, the execution risk here. Turning around a big brand like Tommy Bahama is not easy.
So for all those reasons, we're kicking things off with a market perform rating. Look, management is doing an absolutely fantastic job managing the things they can control, like tariffs. But the path to getting back to consistent, strong growth, well, it's still got some big hurdles to clear.
So, with that rating in mind, what's the trade? Well, we've got a pretty interesting idea for you. How about a pair trade?
You could go long Oxford Industries, betting that they'll continue to masterfully navigate their supply chain. And you pair that with a short position in another retailer, maybe one that's way more exposed to China in those tariff shocks. The whole idea is that Oxford has proven they can handle this mess better than their peers, and that creates a real advantage.
All right, and before we wrap up, the usual reminder, this is not financial advice, just our breakdown of the call. Thanks for tuning in,